Today, we're doing a deep dive into the massive correction that just slammed the precious metals market on January 30th, 2026. What happened? Why did it happen? And most importantly, what does this mean for you going forward? Let's get right into the anatomy of this historic sell-off. So the first domino to fall was gold. We're talking about a staggering 8.35% drop in just one day. A move like that doesn't just happen. It sends serious shockwaves to the entire global market. And just like that, a huge chunk of the recent gains were completely wiped out. But honestly, as bad as that was for gold, the real headline was silver. I mean, this was nothing short of a catastrophic crash. It lost over a quarter of its value in a single day, a 25.5% drop. That's the kind of number that makes history, you know? It signals a massive, almost seismic shift in market sentiment. Okay, so here's how we're going to break this down. First, we'll look at the historical context of this plunge. Then, we'll really get into the anatomy of the sell-off itself. After that, we'll pinpoint the new key technical levels you need to be watching, and we'll wrap up by outlining the 3 core risks that are now on the table. All right, let's jump into our first section. To really understand what happened, we have to put the sheer scale of this event into perspective. This wasn't just another down day, not by a long shot. This was one for the history books. And you could feel it on the trading floors. The word that kept coming up was capitulation. Now, that's not just a correction. A capitulation event is when sellers just completely overwhelm buyers. It's that moment of panic where everyone rushes for the exits at once. So let's look at the data to see just how extreme this was. Gold's 8.35% drop? That puts it right up there with the infamous 2013 crash. But look at silver. A 25.5% collapse? It just dwarfs everything else in recent memory. The big drops in August 2020, even late 2025, they don't even come close. This was a true outlier event. Okay, so that brings us to the big question. Why did this happen? And the answer is, this wasn't just one thing. It was a textbook perfect storm, a combination of 3 powerful macroeconomic forces all hitting the market at the exact same time. And we can break this storm down into 3 key components. First, there was major uncertainty around the Fed. Second, you had a market that was primed for massive profit-taking. And third, a key political risk that was propping up prices suddenly vanished. Let's dig into each of these. So, first up, the Fed. Now, to get why this matters so much, you have to remember what gold and silver are. They're non-yielding assets. They don't pay you any interest or dividends to hold them. That makes them incredibly sensitive to what interest rates are doing. So when chatter started about a potential new Fed chair who might be more aggressive with rate hikes, well, the market immediately began to reprice these metals downward. The second ingredient in this perfect storm was just how hot the market had gotten. I mean, look at this. Gold had just ripped 20% higher in January alone. That was its best month in decades. When a market gets that overextended, that parabolic, it becomes incredibly fragile. It was just ripe for a massive wave of profit-taking, and that's exactly what happened. And for the final piece of the puzzle, it was actually good news, which is kind of ironic. The threat of a U.S. government shutdown was averted. Now, that reduced a lot of political uncertainty, which sounds great, right? But for gold, that uncertainty was a source of strength. It created a fear premium. When that fear disappeared, so did a key reason for holding gold as a safe haven asset. Hey, just a quick pause here. If you're finding this analysis useful, do us a favor and hit that like, share, and subscribe button. It really helps us out, and it means you won't miss any of our future breakdowns. All right, so after a storm like that, the entire landscape changes. An event this big completely redraws the technical map. So let's talk about the new lines in the sand, the key support and resistance levels everyone is watching now. Okay, these are the numbers that really matter right now. For gold, the latest close was $4,907.50, and that key short-term support level to watch is now $4,820. For silver, it closed at $85.25, and its crucial support is down at $79. It is absolutely critical that prices hold above these levels. If they don't, we could see a much deeper slide. And on the flip side, those recent highs are now going to act as a major wall of resistance. So, taking all of this into account, the macro environment and these new technical levels, we can really boil down the forward-looking outlook to 3 core risks. These are the things that every single investor needs to have on their radar right now. So, here they are. Risk number one is a failure of that key support we just talked about, 48.20 for gold, 79 for silver. If we break below those, you can bet it will trigger a fresh wave of selling. Risk number two is a deeper technical correction. Prices could easily pull back another 10 to 15% to test their 50-day moving average. And finally, the big one, a major monetary policy shift. If a new, more hawkish Fed chair comes in and signals more aggressive rate hikes, that would strengthen the dollar and put even more pressure on non-yielding assets like gold and silver. And all of this leaves us with the one critical question that will define the next few weeks and months. Was this violent plunge just a painful but necessary reset after a rally that got way ahead of itself? Or is this the first shot in a much deeper, more prolonged correction? The answer really depends on how the market handles the key levels and the risks we've just laid out.